I'm going to share a strategy that will help you become a master with moving averages. Not a subject we touch on a lot, but today you're going to get everything. So if you've watched our videos before, you know they're jam-packed with value, and this one is not going to be any exception to that. Make sure you watch the entire video till the end because we're going to give you a step-by-step process that you can start implementing on your charts immediately. So that being said, let's get into it. Alright, welcome to the ultimate moving average strategy. So what you're going to learn in this video is you're going to learn how to use a simple moving average to trade better than 95% of all other traders. You're going to learn a step-by-step process you can implement immediately after watching this video that can dramatically improve your trading results. You're going to learn how to use the most influential price action pattern to help predict market direction. You're going to learn how to correctly enter the market with minimum risk and, of course, how to exit for maximum profit. So let's get right into it. So first, let's talk about how most other traders use moving average lines. So most new traders are taught to simply buy and sell when price crosses over the moving average line. Maybe they're waiting for a candle close on the other side, some sort of trigger. But usually it's pretty self-explanatory. When price crosses to the short side, they sell. When price crosses to the long side, they buy. Pretty straightforward. So when backtesting this, it may seem like an easy, viable trading strategy. Most traders will look at past market data. They'll basically custom fit a moving average to look really nice on that data and think this is going to work going forward. So it may work a few times after they optimize the moving average, but overall, it will result in net losses in the long run. So if that's the case, then what's the real reason moving averages stop working? The simple answer is because market cycles change frequently, which causes moving average settings to become outdated over time. So most new traders don't understand that the market even goes through different cycles in the first place. But the truth is that understanding different market cycles is the single most important thing you can learn when it comes to trading or investing in general. It's very, very important you learn about market cycles. So let's take a look at a brief example here. In this screenshot, we have some market data. I believe it was taken from Euro USD, and we've overlaid a 50-period moving average. Now, just in this small snapshot of data, you can see that there are quite a few moving average crossovers. So if you are trading in this period of price action, there's a lot of opportunities to buy and sell at the crossover, but you'll notice that they're all mostly roughly in the same price range. And if the market doesn't trend eventually from one of these crossovers, and then recrosses against you, it's going to usually result in net losses, especially over time. So what ends up happening is that when the market gets into a situation like this, most traders will recognize that. They'll realize, okay, I'm losing quite a bit. And what they do is they re-optimize their strategy. In this case, it's the same market data, but now we've changed to a 15-period moving average, and this now looks and feels a lot better. Still having some crossovers in roughly the same neighborhood, but at least if you're getting in and out on the crossover, you have more of a chance to make money. So most traders are going to continually re-optimize their strategy over and over and over again and never really keep up with the market cycles. But as you'll see in the rest of this video, you're going to actually learn how to use a moving average, but first take into account the current market cycle so that you don't fall victim to this constant re-optimization, resulting in net losses. But before we move on, I want to share a tidbit of information that I thought was kind of interesting. Early adopters of moving average calculations were two guys, Robert Brown and Charles Holt, in the early 1940s. They didn't invent the moving average calculation, but they were some of the very first early adopters. So they were employed by the U.S. Navy. Brown and Holt used moving averages to help predict submarine locations during World War II. So they actually used that calculation to predict where submarines were most likely to travel to next. Later, they used the same moving average calculations to forecast the need for spare parts or for inventory control. Then rocket scientist Pete Hurlin was the first to use moving average calculations to predict stock prices since he had access to a computer in the early 1960s, being a rocket scientist and all. So, if you didn't know, now you know. Thought it was kind of interesting. Back to the lesson. So, I've been bringing up these market cycles, saying how important they are. The question is, what's the best way to understand market cycles? We gotta have a quick lesson on that. So, I've prepared one slide that will pretty much sum it up. Introducing the master pattern. The master pattern is one single price pattern that embodies all market participants' trading activity and behavior, It's the most important pattern you can learn and serves as a gold standard for tracking price action defined market value. Let me explain it further. So remember how I mentioned before how it's the market cycles that really matter, and that's what messes up moving average systems over time? Well, understanding this pattern is what's going to help you understand what phase the market's in. And the market falls typically into 3 phases of price action. The first phase is contraction. You may know this as consolidation or just those choppy sideways markets. That's called the contraction phase, and it's the most important phase the market goes through because it defines value. There's an average price that comes out of that contraction zone that draws forward on the chart and defines a future value price that both buyers and sellers have agreed on in the past, and that becomes a significant level to understand what's possible in the future. So the contraction phase is that first phase. The second phase is what we call expansion, or price exploration is usually a better way to describe it. What happens is that you get increased institutional volume come into the market once you leave the contraction area, and then it starts exploring higher and lower prices, kind of oscillating back and forth. Some people call this kind of a whipsaw breakout. That's usually what it looks like on the chart. You'll find in this phase, this is where you find the really, really good entries, which we're going to visit here in a little bit as we explain the rest of the strategy. And the third and final phase is what we call the trend. We're very familiar with this. Everybody loves a trending market. It's the easiest to make money in. So this is the phase that we're all mostly interested in. And this is defined by a sustained deviation from the previous value point. Market's either going to travel to higher or lower prices, and then when it gets there, it's going to establish a new contraction point, which eventually leads to the 3 phases playing out again. And this happens over and over and over again. And you'll notice that any market you look at, you'll be able to see these 3 phases popping out if you understand what to look for. So before we move on, let's cover a few more facts concerning the master pattern. Number 1, the master pattern is always active in every liquid market, including equities and crypto markets. One of the most frequent questions we get through our website and in the comments on our YouTube channel is people asking, does this work in anything besides Forex? The answer is yes. As long as the market has good liquidity, it's not thinly traded, then you will be able to see this pattern and use it to your advantage. Second, it can be seen and tracked on all time frames. Another huge question we get through our website, does it work the same on a 1-minute chart as it would work on a daily chart? The answer is yes, just obviously the difference in how long it takes to play out is going to be different on a 1-minute as opposed to a daily time frame. But yes, it is the same across all time frames. Now, how can it help you with the strategy that we're covering? This pattern can be used as a price action filter, meaning this can help you filter out markets where most likely you're going to get beat up because you understand the cycle. We're going to cover that more here in a second. So by understanding what phase the market is in, you can better expect when moving average lines will be more effective according to your specific time frame that you are trading. So if you want more training on the master pattern, you can watch our full master pattern training video, and we walk through everything about this pattern. If you haven't already seen it, I would go check it out as soon as you're done watching this video. So how do you use the master pattern to effectively maximize your moving average lines? How do you use that information and translate that into a moving average strategy that actually works? Well, I got a step-by-step plan that you can start using right after this video. So step number 1 of the strategy has to do with how you actually perceive a moving average. And let me give you a clue. You have to perceive it differently than what the masses do. Step number 1 says you want to start seeing the moving average line as a representation of the changing tides of overall sentiment rather than an exact price guide. Now, here's what I mean by that. Most traders use moving averages for exact risk levels, which will constantly cause them to be stopped out. Like we saw in the example earlier, when you get in those tight sideways markets, there's a lot of crossovers that end up being false and you could get stopped out. You want to use the moving average to understand what they're thinking and how prices will potentially be manipulated at the crossover point. So when it's crossing over, you want to understand how are the institutions going to use this to create liquidity? How are the smarter, bigger players going to use this visual crossover to their advantage? You'll notice there's a lot of clean, easy crossovers like we have highlighted here where traders will see that and they'll want to sell the market. But you'll notice if you backtest and you look back At any moving average setting, you'll see a lot of this. You'll see price manipulation happens right after that. Those traders that originally traded the crossover end up getting stopped out. And that's because that's a strong point that the market can be manipulated by the smarter players. Same thing down here. We have a clean, easy crossover. Feels like an easy buying opportunity, actually puts you into the money, but then followed by price manipulation, stopping those traders out. And you'll notice in both of these circumstances, both of when the traders sold and when they bought on both these crossovers, the market actually eventually did what they thought it was going to do. But if you don't understand that these can be potential manipulation points, and you don't understand the master pattern that's happening behind the scenes, then this could be a very frustrating situation to deal with. So in a nutshell, step number 1 is for you to start looking at those moving averages as an insight into what other less informed traders might be thinking and see how price acts around those crossover points. Step number 2 is to calibrate your moving average line to represent the price flow average of a higher time frame chart. So this is going to serve as your filter in directional bias. Let me show you what I mean by this. In this example, I have 2 charts side by side. USD CAD is what we took the data from. You'll see on the left side we have the daily chart. On the right side, we have a 1-hour chart. So what was I talking about when I say calibrate your moving average to represent the higher time frame? Well, this is what I mean. You want to use the moving average line to represent the average price flow of 2 daily candles or 2 candles of whatever your higher time frame chart is. In this example, I have a 1 hour into the daily. So, but you want to calibrate it to represent the average price flow of 2 of those higher time frame candles. In this case, we have the daily. So, how many 1-hour candles are in one day? Pretty simple answer. There's 24 hours in a day, so there would be 24 1-hour candles. We would times that by 2, so we have an average of 2 days, 2 daily candles, which would be 48. So you should use a 48 period moving average when trading the 1-hour chart into the daily. Step number 3, you want to plot out the last daily value line, and I'll say in our case we're using the daily chart in our example, but this would be whatever your higher time frame chart is. You want to plot out the last value line and then wait until your higher time frame is clearly in the trending phase or at least in a big enough expansion phase to justify enough upside opportunity. Let me show you what I mean by that. In this example right here, we have our daily chart. It's settling under value, which shows that the higher time frame players are likely preparing to move the market to lower prices. So we've seen the contraction. We've seen the expansion, that first and second expansion leg. Now we're seeing that price settling, which clues us into prices are probably going to now move downward. So we're in preparation for that move. Okay, so now that we've done our homework on the higher time frame, step number 4 is to now start tracking value on your lower time frame. Let's go back to the example. Again, we clearly see that the daily has settled below value. It's starting to move down. We can start tracking value on the lower time frame. In this case, we have the 1-hour chart. You want to find the most predominant contraction points as they develop, and then you want to draw boxes over those contraction points to define value on the lower time frame. Step number 5. Now we want to use the value lines on our lower time frame to define discounted or strong entry points in trend with the higher time frame. You'll notice that we have the 2 value points marked up, but what was the price action in and around those value points? Let's talk about that. All prices above value will be considered inefficiently priced, and this is key, in a true downtrend. If your higher time frame is truly in a downtrend, which you should be able to decipher based off of what phase it's in, then all prices above value on the lower time frame will be considered inefficiently priced, and they should equate to strong entry points for you to take advantage of. So you want to sell the market above value in a downtrend. Obviously, this would be the opposite in an uptrend. And then after you do this, where does the moving average come in? You want to use the moving average line to make sure the wave of market activity remains in your favor. So rather than getting suckered into those false crossovers and every little crossover that can happen with the moving average, you start to see that moving average is just a wave of sentiment, but you're fine-tuning your entry points based off of the master pattern, based off of understanding the true market value that you're dealing with in that price range. So that pretty much covers the basics of how to identify the setup for the strategy. Now let's cover the rules, because no strategy is complete without some really hard to execute rules. Just kidding. So, the first rule is to not set rigid rules. What do I mean by this? You don't want to set hard stop loss and take profit rules, because if you always have a 10 pip stop and a 10 pip limit, or 20 pip stop and a 20 pip limit, and you say this is what's always going to work, remember the market cycles are going to change, and those stop loss levels are going to have to adapt with the market, which brings me to the next point. You want to be flexible and adjust your position size and your risk allowance according to the market framework that you're given to work within. Remember, when you're dealing with market framework, you're dealing with the contraction points that the market presents. This is something the market defines and not us. So we want to be flexible enough to adapt our position sizing and our risk tolerance to the market framework and not what we want it to be alone. Third point. Don't trade until you feel confident about the future direction of your higher time frame. This is a huge mistake people make when trading this general strategy, is that they feel like I'm a trader, I need to be in a trade. They just look at the lower time frame and they say, that looks enough like a trade I'm in. You want to wait until you feel great about the higher time frame. You understand what cycle it's in. You understand the sensitive points. You understand where the trend is likely gonna take place to higher or lower prices. When you feel great about that higher time frame, that's when you start looking at the lower time frame for your actual entry point. And the last thing is you really want to be careful trading around big news releases. This goes for any strategy that you're using to approach the market. Whenever you have a lot of liquidity that can suddenly come into the market, it can cause the market to spike, which can result in quick losses and substantial losses. So you really want to stay away from those. Examples would be like non-farm payroll, GDP, and Forex. Just let those things pass. The only thing that I would say is different to this, though, is if you're already in a trade, let's say on the 4-hour time frame or 1 hour, and you're already, say, 50 or 100 pips in the money on the trade, well then, you know what? The news very well may snap the market in your favor, and what is 100 pips up now is 200 pips up, because the news is just going in trend. That would be the difference. If you're already in the money on the trade, then you've kind of earned the right to ride through the news if you want to. Now, it could snap and take it all away too, but when you're in a fresh trade and news is about to come out, that's where it gets kind of dangerous, because it can snap and put you out of the money and hit your stop losses, and all kinds of things can happen right when that news hits. So you really want to either make sure you're in the money significantly, or just wait it out, let the news hit, and then see how the market sets up after that. So now let's talk about profit management. You've seen the setup on your higher time frame. Now you've entered on your lower time frame. So the profit management should be based on how price reacts to the most recent value line, and this is on your lower time frame. This is what's going to give you clues to future direction. So in this scenario 1 right here, you've sold above value. Let's say that this is your lower time frame. There's 2 scenarios that can happen at this point. You see that price is at the value line right now. It's either going to get through or bounce. In this case, we have a bounce. In this situation, you would want to cut the trade with a small loss. Once it's hit that value point, it's had the chance to go. It's had the chance to revalue in trend. It didn't. It's bouncing. Might as well get out at break even and see if it sets up at an even better price. Gives you an opportunity to get in at a better price and potentially make more money. Now, scenario number 2, price gets through value. This is what we're gonna consider this a complete trade. When price goes through value in trend, now you're in the profit zone, and you want to manage this as best you can to see as big of a profit as possible on the trade. But once you get through value, remember, there's no going back. You do not want to take a loss on this trade. Now you're just trying to ride it as best you can and see what you can milk out of that trend. Now let's talk about practical ways that you can manage your risk when using this strategy. And this actually goes for our basic strategy as well, whether you use a moving average line or not. This is just good general guidelines to manage risk. So 2 techniques we're going to talk about. Technique number 1, use previous market framework to define risk. In this situation, we have 2 contraction points right here showing us 2 value lines. If you see where the price is right now, it's actually bouncing off of the higher value line. What this shows us, obviously we see it's in a downtrend. We see that price reaction. That could potentially be used as an entry point, and then we would enter and sell there above the lower value line, so it's still within the strategy guidelines for entry, but then use that higher value line to define our stop loss, and that would show us where if that price gets through that value line, maybe this trade isn't what we thought it was. Cut the risk, very, very small right there at that value line, and then reevaluate. But in most cases, in a true downtrend, you'll see that price will hold, and we call this walking down the ladder. It's actually walking down the ladder on these value lines in trend, and those can provide some really, really solid entry points. So let's look at one more example when it comes to risk management. In this situation, we have a defined uptrend. We have a contraction zone that we're working with that value line painting forward. That gives us some framework to work with now. So in technique number 2, what we do is simply calculate a 1-to-1 risk-to-reward ratio based on the price revaluation in trend. Now, when would you want to do this? You would want to do this if you don't have that prior framework to work with, or if it's simply just too far away. If the trend has already moved, say, 50 or 100 pips in a given direction, and you don't want to go 50 pips negative, then you simply just calculate your upside to the value line that you're working with. Let's say your entry is 20 pips away, just returning to value, then you would simply just kind of use that as your stop loss. That gives you a simple 1-to-1 risk to reward ratio, and that's just returning to value. Remember, the idea is not to just get back to value. That helps with our strong entry point, but the idea is to get through value. So this is just that initial risk where just to get back to value if it's an existing trend, if it's a true trend on the higher time frame, it's typically always going to at least come back and touch value. Even if the trend is falling apart, it'll come back and touch value. So you have that 20 pip upside, the 20 pip downside, but if you get through value, now you're in that profit zone, and then you can manage the win from there. But you can see this is just a simple way when you don't have that existing framework that is convenient to work with. Then just use that 1-to-1 risk-reward ratio, and that should typically keep you safe when you're entering a trend that has some real strength to it.